China's Teapot Refineries, predominantly located in Shandong province, have emerged as pivotal players in the global oil landscape, processing approximately 4 million barrels per day, about 20% of China's refining capacity. These small independent refineries have capitalized on heavily discounted Iranian crude, a byproduct of US sanctions reimposed in 2018, which initially slashed Iran's oil exports from 2.8 million barrels per day to a mere 150,000 by 2020. However, by 2025, exports rebounded to an average of 1.65 million barrels daily, with Chinese teapots absorbing up to 77% of this volume. First, the economic viability of teapot refineries hinges on their access to discounted Iranian oil. Operating on thin margins and often underutilized, these refineries have relied on clandestine networks involving shell companies and dark fleet tankers to import Iranian crude discreetly. This strategy has allowed them to remain profitable despite market challenges. Second, the potential lifting of US sanctions on Iran poses a significant threat to teapot refineries. If sanctions are removed, Iran could openly sell oil on global markets, reducing the discounts currently offered to Chinese buyers. This shift would attract larger, state-owned or global buyers capable of paying higher prices, thereby undermining the teapot's cost-based business model and threatening their profitability. Third, recent U.S. enforcement actions have already impacted Iranian oil flows to China. In 2025, new sanctions targeted several Shandong refineries and port operators, leading to a decline in China's Iranian oil imports to around 50% of Iran's total exports. The increase in Iranian crude stranded at sea indicates a cautious approach among Chinese buyers, who are awaiting clarity on sanctions. Fourth, the broader implications of lifting sanctions extend beyond China's borders. Iran could rapidly release oil currently stored on tankers, increasing global supply and potentially exerting downward pressure on oil prices. This development would not only affect teapot refineries, but also have far-reaching consequences for global oil markets. Fifth, the geopolitical landscape is evolving. President Trump's dual strategy of enforcing maximum pressure via sanctions while negotiating a nuclear deal has created uncertainty. Recent statements suggest a potential breakthrough in talks, but outcomes remain uncertain due to the complex nature of negotiations. Sixth, the sustainability of teapot refineries is further challenged by China's internal policies. Beijing's push to eliminate inefficiencies, coupled with increasing electrification of vehicles and slower economic growth, has led to a decline in fuel demand. This shift is driving a consolidation in the refining sector, with smaller, independent refineries like the teapots being the most vulnerable. Seventh, the environmental and legal risks associated with the clandestine operations of teapot refineries cannot be overlooked. The use of dark fleet tankers and falsified documentation to import sanctioned oil exposes these refineries to potential legal repercussions and environmental hazards, further jeopardizing their future. China's teapot refineries have thrived by exploiting the loopholes created by US sanctions on Iranian oil. However, the potential lifting of these sanctions, coupled with internal policy shifts and environmental concerns, threatens their survival. The coming months will be critical in determining whether these refineries can adapt to the changing landscape or face obsolescence in a rapidly evolving global oil market.